For those of you who are new to the call, we do a quarterly webinar to kind of take a look at what's happened over the last quarter and what the outlook for the near future is as far as the markets, economy, politics, and other interesting topics are concerned. Today, we have Chris Drawn and myself. Ashley Sheridan is out today, won't be joining us, but Chris and I will do our best to give you a good snapshot of what's been going on and some prognostication about the future. Everyone is on mute. You can type questions in on the right-hand side of your screen, and we will do our best to answer them. If you have any questions, feel free to just put them in there, and we'll get to them. And in addition, this webinar will be reposted on the website tomorrow for replay purposes if you'd like to watch it again, or if you'd like to forward it to someone that you think might be interested in watching it. Feel free to do so. With that, we'll get going. We're going to kind of do a first quarter recap for you, talk about what happened over the last 3 months, talk a little bit about the outlook and some themes to kind of pay attention to and watch going forward. And then, as always, we like to wrap up with kind of a planning tip or a planning thought that relates more to your long-term planning needs. In terms of the first quarter vital signs, a lot of economists have taken to calling this the plow horse economy. The plow horse economy refers to the fact that things are just kind of plodding along, that economic growth in the 2 to 3% range is neither positive nor negative. It's not bad enough for things to be going backwards. It's not good enough for unemployment to be shrinking at an acceptable rate, and for economic growth and prosperity to be showing itself. So we are still mired in this plow horse economy where things are just plodding along. Growth has been steady to softening. In the fourth quarter of last year, we saw economic growth at about 2.8%. That number is likely to be softer for the first quarter, largely due to extraordinary weather that you experienced pretty much in any state you were in during the winter. I know I've heard old colleagues complaining up in the D.C. area they had snow on the ground as late as early last week, and so those extreme weather events will undoubtedly take a toll on first quarter numbers for economic growth. Just in the last week, as some economic reports have come out, particularly payrolls, what we've seen is good news, very, very good news, coming out of the muted kind of weather-burdened first quarter, kind of indicating that things may be back on track now that the weather's warming up a little bit. But undoubtedly, we would expect the first quarter numbers when they come out to be a little soft, primarily due to the weather. Just some things to note. The consumer confidence numbers are down largely as a result of first quarter. Housing starts are moderating to soft, and the service sector has softened. And again, some of the softening and some of the decline in these numbers is weather-related. We really won't know how much of it is due to weather until we have another quarter or so under our belt to see whether a softening trend in the economy is developing or whether it was just largely attributable to weather. Just covering a couple of other vital signs. First, jobs. Unemployment is somewhere around 6.7% right now. Labor market is strengthening, but it's very slow. The payroll reports that came out today were well above the averages of new jobs. Monthly new job additions were up about 20,000 over the averages as of today when they announced it. So again, how much of that was related to weather-related softness in hiring in the first 3 months of the year, and how much of it is due to economic expansion, we won't know until we have a few more months of data there. But the unemployment rate is stubbornly high. We've talked about this in the past, that a lot of the positions that were eliminated during the recession in 2008, early 2009, companies invested in technology and productivity enhancement, so some of those jobs are not coming back. The folks that were doing those jobs are going to have to go do something else. Some of them are what they call the long-term unemployed. So this is going to continue to be a difficult hurdle to overcome. Economic growth of 4.5% would help absorb a lot of the unemployed now. But at 2 to 3% economic growth, you're just not getting the economic expansion you need to reduce that number. In addition to that, inflation is still fairly benign. 1.6% annualized rate. I would advise people not to get too comfortable with that number, despite the fact that inflation has been low for the past 8 or 10 years. The average inflation rate over the last 50 years is north of the vengeance. You don't print money nonstop like Washington has been doing without inflation. It's just the two go hand in hand, and inflation will return once we see the economy heat up and signs of expansion. You can count on the fact that inflation will be close on its heels. The latest estimates for when we might see inflation numbers start to increase is sometime late 2014 to early to middle 2015. We'll just have to keep an eye on it and see, and we'll do that at these quarterly reviews. But for the time being, it remains fairly benign. Interest rates are still low for now. The latest prognostications by the Federal Reserve, who I'll talk about more in a minute, are that while they have begun to taper quantitative easing, they are still deeply concerned about jobs and about the economy, and they continue to believe the way to spur economic growth is to keep rates artificially low. That has an effect on the stock market, the bond market, and we would expect to see those rates continue to remain low throughout 2015. We did see rates move up last year about, what was it, Chris, 100 basis points. About 100 basis points. So, the 10-year bond went up about 100 basis points during the year. We all saw the effect that had on the bond market last year. So as interest rates do creep up in the future, we'll see the attendant effects of that, both in things like housing and in bond returns. But for the time being, we expect them to stay low and expect rates to moderate throughout the rest of this year. That's kind of what we're reading, and what we're seeing is an interest rate spike this year is not anticipated, at least to the extent that we had it last year. In terms of corporate profits, which we all know are the engine that drives the stock market, 2013 was a record year. All of the productivity increases and the technology enhancements that companies implemented over the last 3 or 4 or 5 years have been paying off handsomely. Profits have never been as high as they are right now for companies. The fact is that the other side of the coin, though, is that the rate that profits have been growing is unsustainable, meaning that it cannot continue forever. Trees don't grow to the sky. We're seeing some softening in the 2014 numbers, and earnings season starts next week. So we'll begin to watch and see how earnings look relative to expectations. That could present for a little choppiness in the stock market, depending upon how the numbers look. So, while they're a little bit softer, they remain relatively steady. And again, if we had only one thing we could watch to help us kind of divine what general direction the stock market might be going, if we could only look at one thing, it would be corporate profits, because at the end of the day, that is the engine that drives growth in the market. Meanwhile, in Washington, we're beginning to hear all the midterm election scuttlebutt about, will the Republicans take over the Senate and have control of Congress? Depends on which pundits you listen to on which show. Too much fog right now to make any kind of predictions about that or about what that might mean politically in Washington. It's hard to make any forecasts when your congressional approval rating in the country is around 12%. Hard to make any predictions of anything positive coming out of the midterm elections. There's plenty of negative news there. I did read today an interesting sidebar that fully 50% of Congress, the current members of Congress, are millionaires. Yesterday, an outgoing member of Congress put forth a bill to give everyone in Congress a raise, since they haven't had a raise in a couple of years. That was defeated soundly in the House. Didn't make it anywhere when someone noted that 50% of our leaders are all millionaires. It was believed they should spend a little bit more time lawmaking and a little bit less time worrying about giving themselves raises. So we'll be providing a little bit more feedback on what the midterm election forecasts look like as we get closer to them. We've done that in the past, and people have seemed to enjoy that. So we'll make sure that data is available in the next two forecasts. In terms of the Fed, I want to spend a couple of minutes talking about this quantitative easing because the fact is that we're all aware that the Fed has stopped buying as many bonds as it's been buying each month to the tune of $10 billion a month. They're cutting back, and we applaud the taper. We think it's a good idea for them to stop doing that and to stop inflating the balance sheet of the country. But the fact is that this quantitative easing has not been successful. It has not worked. All it's done is created really easy money. And the Fed seems to still be clueless about this. Our new Fed chair, Janet Yellen, in her first two public speeches, somewhat contradicted herself in the second one from the first one, which caused some confusion. But as concerned as they are about jobs and as concerned as they are about economic expansion, the belief somehow that continuing to buy bonds in the marketplace to keep rates artificially low and thereby inflating the Fed's balance sheet, they see that as a solution, and it's clearly not a solution, and we're a little bit confused about why they continue to do it. If you look at the chart on your screen right now, what you can see is the Fed's balance sheet against the S&P 500, or the stock index, since quantitative easing began back in March of '09, which was really at the bottom of the recession. Or actually it was at the trough. That's when things started to turn around. And you can see that quantitative easing has actually been very, very good for the stock market. But in fact has dramatically inflated the Fed's balance sheet. We've gone from buying, what was it, $85 billion a month in bonds each month, Chris, to they're down to
about half that.
Yeah, so they're down to like 55 now, and they continue to taper by $10 billion a month. But you can see the effect that the taper had on the stock market on the far right side of this chart. When the taper actually began, we saw a fair amount of volatility in the market, and in January the stock market was off about 10% for the month, much of which it has recovered. Chris will talk in a minute about kind of a market recap. Effectively, markets were flat for the first quarter, but just calling them flat would be far too boring. We had a fairly dramatic downdraft in January and a fairly good February that erased much of that. But it was largely attributable to the announcement that they were going to begin the tapering. And so stocks like easy money. Stocks like liquidity and low interest rates. And when liquidity dries up and interest rates go up, markets tend to get a little choppy, and we may see more of that in the future. Markets were very robust last year, as all of you know. The S&P 500 was up over 30% for the year without a correction during the year. Normally the market has about a 10% correction during the year. We had no correction during last year. And people got, I think, a little too comfortable with it, and also a little too comfortable that a lot of the fluctuation and the volatility has been absent, and we would expect to see some of that come back as the taper continues. But we need to put the market in rehab and get it unaddicted to easy money, because that is not the answer, and I'll prove that to you in a minute. What you're looking at here is a chart that shows the velocity of money, and it's an economic principle. I'll just boil it down to a real-life example. The theory behind the velocity of money is that as a dollar goes to work in the economy, it creates more than a dollar. And the example of that would be, assume you were a contractor and you got $1 million contract from the government to build a road. You would have to take a portion of that $1 million and go to suppliers to buy the raw materials and the equipment that you needed to construct that road. By putting that money into those companies are paying employees, keeping employees employed, and those employees will go out and spend that money in the economy. You would also have to hire a bunch of people with some of that money to go out and build that road for you, and in turn those people would take that money that they received and go out and buy more goods and services with the money that they received. So that $1 million flowing through the economy and touching all of these institutions, these companies and people and grocery stores and everything else is what is referred to as the velocity of money. Money increasing as it flows through the economy. What you can see is a chart showing money velocity since 1960, and you can see that since about the year 2000, that the velocity of money has actually been slowing down, and certainly has continued to slow down despite the fact that the Fed is injecting all this money into the economy. And what this would tell us is that, in fact, the Fed flooding the market with all this money is not, in fact, having its intended effect of creating more money velocity and creating more prosperity. And further to that point, this is kind of an interesting chart. Let me just, if I could, slide this over so I can see it. Yeah, so the Fed has increased its balance sheet, as you can see, about $1.4 trillion since September of 2012 through quantitative easing. Right? They've added $1.4 trillion worth of assets and liabilities to their balance sheet. Okay? But right below that, you see reserve balances at banks. And you see that the reserve balances that banks maintain is up $1.1 trillion. What that would tell us is that only about $300 billion of that money has gone back into the economy. It's actually out working in the economy to create jobs and economic prosperity. And to us, that would represent a failure, that, in fact, it's not working, that this quantitative easing doesn't work. Since that time, you can see 10-year rates are up about 113 basis points, so from 1.65 to 2.78, and they're a little bit higher than that right now. You can see housing starts as a result of that are they're down 44%. I wouldn't necessarily refer to that stat, though, and here's why. Back in September of 2012, we were coming out of the real estate bust. It's kind of like a rubber band springing back. When you stretch it way out, you know, it whipsaws way back the other direction. So 51% year over year isn't kind of a long-term estimate. 7% is a more realistic estimate of the long-term number there. And again, that's been fed not so much by quantitative easing, but by natural demand. You know, we demand sagged since 2008 for housing, and so, you know, we had a lot of pent-up, built-up demand for housing. Consumer spending, really no change that's noticeable at all, down a little bit. We would expect consumer spending to be up, fairly substantially if quantitative easing was really working. No real change in payrolls. The 12-month average is around 178,000 jobs. The report that came out today was 192,000 jobs. So again, good news there. More people are going back to work. That's a good thing. But really, no appreciable change from 2012 to 2014. And if quantitative easing was working, we'd see more people, less unemployment than we have. And then, of course, we see the stock market, from that time period up 29% because stocks love easy money. Stocks love liquidity, and stocks love low interest rates. And so how much of the stock market's performance last year was fueled by robust corporate earnings, and how much was fueled by easy money and lots of liquidity is a matter of debate. But we would suggest that both of those were heavy contributors to the market being up so robustly over the last year and a half. Okay, so I'm going to be quiet for a minute and let Chris talk a little bit about the first quarter investment recap, about what actually happened over the last 3 months in the various investment markets, and talk a little bit about what we see kind of the risks going forward are, the opportunities, and kind of the themes to watch out for.
All right. Thank you, Jeff, and thank you to those of you that have taken time this afternoon to join us. We hope that you find this information useful, and as Jeff mentioned, if you think there are folks that you think would find it useful as well, we encourage you to share it with your friends. So last year, 2013, was a stellar year, particularly in the U.S. economy. And we went through some of these numbers at our last update. Again, Jeff alluded to the fact that U.S. stocks, large company stocks were up over 30%, small company stocks were over 40%. And we have to remind people that that isn't a normal environment. The first quarter of this year has proven that so far. So in January, we came out of the chutes, and from the U.S. stock market's perspective, the first real event that came to pass was remarks being made by Dr. Yellen, the new Federal Reserve Chair, and Jeff alluded to this through his analysis a moment ago, that she has made two public announcements, the second one kind of contradicting the first one, and that was her mea culpa, if you will, of saying we may be accelerating the pace of our tapering, if you will. We may be increasing the amount of taper or buying, slowing down the purchase of bonds, and that spooked the market to think that the end of this era was upon us. And as a result, the markets pulled back almost 10%, which would have put us in the correction territory. And as Jeff mentioned, it's normal for a stock market to decline by 10% at some point during the year. Just because it does that doesn't mean that it ends in negative territory, but it's normal for a correction to take place each year, and we hadn't had one, and this was an excuse for the market to pull back. Through that, a couple of weeks later, we had Ms. Yellen come back out and correct herself in the eyes of the marketplace of what she meant to say was simply that we're continuing with our prognosis, and we're continuing with the pace that we were on, but we're going to continue to give ourselves flexibility. That if the economy has sped up to a level that we feel like we can accelerate it, so be it, but we have no plans of slowing down what we're doing. So that gave the markets reassurance that the liquidity, the easy money, was back on the table, and we saw the markets come back, which has put us to the point where we're at today with the stock market being relatively flat year to date, and the returns that we have earned coming from overseas markets, international markets, as well as in the fixed income arena. So if you're in a balanced portfolio, which is what the light gray box shows, then your portfolio is probably somewhere around the range of a 1 to 2% return year to date if you're a middle of the road type of investor. The chart here really, Jeff introduced this the last two meetings. This is what we affectionately call the Skittles chart, and it shows us the diversification in action, each square representing a different type of asset. And by diversifying our portfolio, we do not find ourselves at either extreme, either on the high end or on the low end, but rather around the middle, which gives us a more consistent return pattern. So in a diversified portfolio, we manage risk. We reduce risk of extremes through that diversification. And a diversified portfolio so far year to date has returned somewhere between 1 to 2%.
And I would mention, too, for those of you who are clients, you'll be receiving your quarterly consolidated reports from us in the next couple of days, probably. And that's in all likelihood what you're going to see on your reports for balanced or kind of average investors are going to be somewhere between 0 and 2% for the first quarter. We find these charts helpful for explaining to people what explains my returns. You own, in your portfolio, you own all of these colorful boxes. You own the ones at the top as well as the ones at the bottom in varying amounts. Okay?
So let's turn our attention to what could be the derailers, or what are our potential risks that keep us up and need to be awake on. When we look out across the globe, there are a number of obvious risks that we see that could potentially be derailers. Some of those are with regards to geopolitical risks. The example that many of you are probably familiar with is the annexation of Crimea by Russia. And if you haven't been a history buff, you may have forgotten what Crimea was all about, but the borders on our global maps. So that could have implications. We could have implications in the Middle East as the United States continues to produce more oil. That reduces our reliance upon the Middle East. If we're exporting that to Europe and China is receiving more of Russia's output, then the output produced by the Middle East would be reduced, and that could result in geopolitical risks. So there's always the potential for something going on around the world that could cause us heartburn. The Federal Reserve, again, I will be clear here. Some of our opinions may differ between me and Jeff, but nonetheless, the Federal Reserve does play an impact in the effect of the economy, in the effect of the stock market, and in the effect of interest rates. And if the market does not like what the Fed is doing, then it could cause a risk to the portfolio. And so if the market perceives a misstep or a misquote like it did earlier this year from Federal Reserve officials, then that could give a reason for the markets to increase in volatility. Credit conditions, in some respects, credit conditions have been very good. But if they were to deteriorate for some reason, that would be an issue for causing heartburn as it relates to our portfolios. And then the emerging markets continue to struggle. I would remind people that the emerging markets, we have a couple billion people entering the middle class. And so over a short-term period, in economies that are driven by foreign capital, money being invested from U.S. institutions into that economy, in which that money was very easy to come by because of accommodative Fed policies. And if the Federal Reserve decides to turn that spigot off, that money's going to come back out of emerging markets. And we've seen that. And that's created negative returns in emerging markets. But I think long-term, there's a significant amount of growth opportunity in emerging markets. So while they may be struggling now, that doesn't mean that we shouldn't own them. It does, however, create a level of risk that we have to be conscious of.
Yeah, and let's go back for a minute and look here at this chart. If we go back and look at emerging markets, let me go show you an example. Here we see in 2009, after the crash, emerging markets were up 79%. In 2007, they were up 39%. In 2005, they were up 34%. So we advocate having some exposure to them, but not too much exposure because they're a very volatile class of assets. But as they've gotten cheaper, over the last year or two, it makes sense to own them as part of a diversified portfolio.
Some themes to watch for. Again, we are embarking upon earnings season here in the U.S., and earnings season, profitability of companies are what long-term investors respond to with the value placed upon businesses. If profits continue to improve, increase, continue to be positive, that's good for stocks. If earnings are negative or come in below expectations, that could be bad for stocks. Examples of that in action, earlier this week, Alcoa released their earnings, and they were better than expected. They got a nice bump in their stock returns. However, Bed Bath & Beyond reported their earnings this morning, or late yesterday afternoon, one of the two, if I remember correctly, and their stock fell about 7%. So earnings drive the value of stocks from a fundamental point of view, and so we'll be consciously watching what the earnings reports tell us.
Yeah, and let me add something to that. I put in here that stocks are fairly valued comparatively speaking. What I mean by that is, as of the last year or two, stocks have been the only game in town. It's been the only place to earn a potential return on your money. And so from that perspective, stocks are fairly valued. There are those out there who would tell you that stocks are in fact modestly overvalued, assuming there was somewhere else to earn a return on your money. If bonds were attractive today, stocks would be slightly overvalued. But given that there really hasn't been anywhere else to make money, comparatively speaking, they're fairly valued.
Yeah, that relationship is certainly a context that we need to view these asset classes in. When we look at the fundamental analysis of profitability versus share price, and we compare that to what has been the average. So when we look at what has been the average share price of the S&P 500 relative to its earnings, the current level that we find ourselves at is pretty close to that average. On some metrics, we're slightly overvalued. On many metrics, we're right in line, which is all the more reason why we need to have diversification. When we look at the value of international stocks or Pacific Rim type of stocks, Asia, Japan, the emerging markets, the value there is greater than the value of U.S. stocks. So having exposure across the globe helps diversify and take advantage of and reap the growth opportunities as these economies mature and continue to expand out of their recession. So we believe that across the board, stocks are fairly valued and probably somewhat undervalued in our international markets. Bond markets, our general premise is to focus on that preservation side of our portfolios using things that have limited risk. And in fixed income, that means generally we keep things with a short maturity, so bonds that are maturing in 5 years or less, and very high quality. The downside to that is those bonds don't pay us much yield. So we need to diversify away from that without taking on additional risk. And so we look to be tactical in that approach and incorporate investments that have a track record of being able to give us above average returns, but with typical levels of risk for fixed income types of investments. And so we would encourage people to be tactical in that area and employ investments that have a track record of consistent success. Finally, we would include the addition of alternative assets in our diversification. Alternative is a fancy word for saying include assets that are not stocks or bonds, that behave differently than stocks or bonds. Typically, these are assets that have only been available to large institutions like insurance companies, endowments, and pension plans. But coming out of the financial meltdown of 2008, regular investors were demanding those same types of access, that same type of access to things that are not stocks or bonds and have a low relationship to stocks and bonds. So when the stock market does pull back, those types of assets generally move forward. When fixed income yields have fallen, those types of assets have risen. So the inclusion of these alternative types of investments like energy, like commodities, like currencies, and any number of other types of assets helps to further reduce the risk in our portfolios. So with that, I'd like to turn our attention to some planning thoughts. And today I want to focus on where do our incomes come from in retirement, what type of expenses are we incurring in retirement, and how can we manage where that income is coming from to give us peace of mind. So generally speaking, there are two types of income that you are likely to have. There's insured income, things like pensions, Social Security, and annuities. These are things that offer you guaranteed income regardless of what the economy is doing. There's going to be a check in your mailbox. And then there's investment income. Investment income comes from your investment portfolio, perhaps your retirement plan, or your savings. And the income that's produced there is not guaranteed. It fluctuates. It has the ability to fluctuate. It may change over time. Coupling that with expenses, there are two types of expenses that you would have. So can you advance the slide there? So we have cost of living expenses, and we have lifestyle expenses. The difference being the items that must be paid for regardless of what the economy is doing, and items that can be paid for, or we have some flexibility in spending or not spending. So cost of living would be our mortgage payment, our groceries, light bill, things of that nature. Lifestyle would be the things that makes life worth living. It might be vacations or cruises or golf or your hobbies or things that are nice to have but not neat to have. And we have the ability to spend that money or not. We have flexibility there. So when it comes to covering those expenses, we need to determine what is the total amount that we need to live on. So we look at what are those items. So the amount to live, pay the lights, meet our basic daily expenses, we want to make a note of that. And you can take this chart that we're going to fill in and use it to determine where's your income coming from and how much of it is guaranteed, how much of it is not guaranteed, how much of it would you like for it to be guaranteed, etc. So we've identified what our basic living expenses are. Those types of expenses generally should come from income that's guaranteed, like pensions and Social Securities or annuities. And so when we complete this chart, you would want to make a note of what income you have coming from those sources, and if it covers your basic cost of living, then great. If it doesn't, it may give you a question to ask, and that is, should it cover those numbers? Next, we turn our attention to the investment income. The investment income, again, this is income that you can pull from your savings, from your investment accounts, your retirement accounts. It might be that you're pulling off the interest or the dividends from those items, or taking a percentage of those account values on an annual basis to supplement your other sources of income. Investment income should cover those flexible expenses, the lifestyle expenses, the expenses that you don't have to have met on an annual basis. So what we've done here is we've classified our needs versus our wants, and we've identified how much of our guaranteed income is covering our needs and how much of our wants are being covered by our flexible income from our investments. And at the end of the day, what we're left with is how much of our guaranteed sources of income are covering our basic needs. How reliant are we on our investment portfolio? The amount that we should be pulling from our investment portfolio should not exceed 4% per year of the total value. So if you have see, $100,000 or so in an investment account, if you pull more than $4,000 or 4% of that on an annual basis, you're at risk of running out of money over the remaining period of your life. So there's this rule of thumb called the 4% rule. And so for our investment income, we generally don't want that to exceed 4% of our investment values on an annual basis. Otherwise, we run the risk of running out of money before we run out of time. Once you have this information determined, again, the components that you want to see is what percentage of your cost of living is being funded by your guaranteed income. And if it's not being funded completely by the guaranteed income, then you may want to make a decision of moving some of the investment income to the guaranteed side of the ledger. And there are ways to do that, and that's where Jeff and I can help you with that. The other component is how much of your total income is being funded from your investments. So if your income on an annual basis is $40,000 and $30,000 of that is being funded from your investment income, leaving you only $10,000 from guaranteed sources, that would signify a high reliance upon your investment portfolio, and the performance of that investment portfolio may lead you to stress if we enter another recession and you can no longer withdraw as much as you were previously. In essence, you want your reliance rate on that investment portfolio to be at a manageable level and not be too high.
Okay. Okay. Well, that concludes the drive-through review for now. We hope this has been helpful for everybody, and we will be doing the next drive-through review of July 10th at 4 p.m. You'll get an email notifying you of that. We'll have a replay of this drive-through review posted on the website either probably Monday. It'll be posted, so you can forward it to friends or colleagues who might be interested in watching it. And feel free to give us a call with any questions that you might have. And thanks for your time. We appreciate you being here.